we are moving into a year where we're going to see a revaluation in gold. And of course, a revaluation in gold because de-dollarizing is going on. And that we haven't even talked about geopolitics. I mean,
Right.
we're talking at war here. This is a
Right.
really potential, of course, we're going to see more physical demand coming in. People are looking for safe havens now. And I think February is going to be a super strong month. I think we're going to have a super strong year. We're going to have a revaluation. Gold is going to be revalued. What the hell is going to happen to silver?
AndrewMaguire, Executive Director and Group General Counsel at Kinesis Money, believes that a gold revaluation is on the horizon in the upcoming year. This conviction is intricately linked to the ongoing de-dollarization process, where the U.S. dollar's appeal is on the decline. Federal Reserve will be compelled to revalue gold, aligning with the consensus among first-tier liquidity providers. This suggests this recalibration will likely occur no later than the physically driven 2024 marketplace. Data from the International Monetary Fund highlights that the U.S. dollar accounted for 59.17% of global allocated foreign exchange reserves in the third quarter of 2023, showcasing a decline of approximately 6% since early 2016. Geopolitical considerations, including the looming potential for war, AndrewMaguire anticipates a surge in physical demand within the gold market, reflecting the global investor sentiment seeking refuge amid geopolitical uncertainties. Central banks played a pivotal role in the gold market last year, purchasing 1,037 tons, just 45 tons short of the 2022 record. The World Gold Council predicts that central bank demand will return to average pre-record levels of around 500 tons in 2024. Juan Carlos Artigas, head of research at the WGC, emphasizes the untapped potential within the central bank community, with foreign reserves still saturated with gold, especially among emerging markets. Maguire contends that current gold prices are unjustified, arguing against the viability of the synthetic side of the trade. He posits that robust demand and commercial entities holding onto their gold reserves will inevitably force a market adjustment, suggesting an impending upward shift in gold prices. The LBMA survey reveals analysts' divided opinions on the primary drivers for gold prices in the coming year. While 25% anticipate U.S. monetary policy as the most significant factor, an equal 22% ties in between expectations for central bank demand and geopolitical risks driving gold prices. Join us as we delve into insights shared by AndrewMaguire. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
If you remember last year, we opened up and we had the opening of Basel III legislation, and we had the gold being morphing into a first-year asset class, and we had the usual pushback from the officials. And we've seen a bit of a pushback because, hey, gold is looking like it really wants to break out. And so we've got a lot going on. And I think, the stories are enormous. I mean, put geopolitics aside just for a second, because obviously there's a lot of reasons to want gold in an unknown situation like now. But that aside, and I mean, as you say, we've got Powell coming up shortly. What we're talking about a little bit of an official intervention. However, as much as every single technical analyst out there was expecting very much lower prices into the 1900s, and in some instances, I saw lower than that. But basically, what's thwarting that is basically de-dollarization, and we're seeing every ramp in the dollar being sold into, and it's not being sold into to buy the pound, the euro, or any other FX currency. Yes, it is the least dirty shirt in the laundry bag, but we're seeing gold being purchased. And I think one of the things where we have a really good insight is into the wholesale market, and we deal with a lot of first-tier liquidity providers who are very open about the fact that there is huge central bank interest, but central bank buying is enormous, and I think you wouldn't notice that if you look at if you're in look at a short-term chart, and you take a chart from the 1st of January and you look into the end of the month here, Well, of course, it was first notice day, and you always expect first notice day to be probably the point where things turn around. So, yeah, but essentially, you wouldn't realize if you looked at that because it's all leverage against an unleveraged physical market, how strong the central bank buying is, and it's nothing. Geopolitics is obviously another factor, but this is about de-dollarization. And it is massive. Of course, we are moving into a year where we're going to see a revaluation in gold. And of course, a revaluation in gold because de-dollarizing is going on. And that hasn't even, we haven't even talked about geopolitics. I mean, we're talking at war here. This is a really potential, very, of course, we're going to see more physical demand coming in. People are looking for safe havens now. So, and I think February is going to be a super strong month. I think we're going to have a super strong year. We're going to have a revaluation. I think personally in the first quarter, just looking at everything, and I know, I mean, we're talking, I mean, this is a strong thing to say, but it just doesn't add up to have gold at these levels. It doesn't add up. There's something, the synthetic side of this trade is not viable. It's just not possible to keep with such strong demand. And because the commercials who are exposed to the physical market, they don't want to give up their big gold hoards and their big silver hoards. Of course, they're not going to give a penny of them. Not 1 ounce is going to get away. So if they can't lay it off on one of these CTAs, of which that we've talked about, that bandwidth shrinking, then of course the price has to come to a point where they're willing to let some gold go.
Yeah.
And I think so. There's where we are, and it's tight, and the physical market is tight. And one of the beautiful things I think, and I know we're sort of trying to wrap up here, but you have a huge process going on in the States, which really has my attention, and it is the safe. It's the this safe money.
In discussions about the silver market, AndrewMaguire highlights a notable surge in physical demand for silver from Indian wholesalers. He notes that these entities are sourcing silver from various channels, including reputable refiners in Switzerland and Germany. In a recent report published by the Silver Institute, it has been projected that despite facing various challenges, global silver demand is set to reach an impressive 1.2 billion ounces in 2024. This projection would mark the second highest level on record. The Institute anticipates robust growth in India within the jewelry sector, driving a 6% increase in yearly jewelry consumption. Maguire expresses surprise at the current silver-to-gold ratio 90-1, labeling it a synthetic trade. He highlights the impact of dollarization on silver, emphasizing that as gold's value rises, the artificial nature of the ratio becomes unsustainable. Maguire raises a crucial question about silver's fate during a gold revaluation, hinting at potential upheavals in the existing synthetic trade dynamics. The gold-to-silver ratio currently exceeds 87:1, meaning it takes 87 ounces of silver to purchase 1 ounce of gold. Maguire draws attention to the historical context, mentioning that as the Federal Reserve implemented rate cuts and initiated quantitative easing to stabilize the economy after prior rate hikes, the gold-to-silver ratio peaked at nearly 93:1. Let's get back to the interview.
I mean, silver to me is really, as we know, is the most undervalued commodity on this planet Earth. There is no other. We all know that, but it doesn't help when you have this game really played inside this bubble, and so it's the dislocations that we're looking at, and so when we made a bottom in silver. That spike bottom that we saw about a week or two ago. I haven't got the charts.
Down to 2204 and 10 days ago.
There you go. I knew you'd know exactly what day it was. Well, but that was the day, that very next weekend, and on the Monday, we had Indian wholesalers. Now, these guys never pay over spot. They don't have to. They know, they're savvy guys. They know exactly where to buy 1,000-ounce bars. Refiners, Dubai, places that you can buy it under spot. Ran out completely. Now, they weren't just chasing us, they were chasing every single desk I know, from Switzerland, you name it. They're saying they'd already been through all the refiners in Switzerland and Germany, LBMA bars. They're not too bothered about an LBMA bar, but yeah, it's because they're going to melt it down. They're going to do all that stuff with it. So they want LBMA bars. They wanted it from the refiners. So seeing as the refiners had no more to give them, and this was on the Monday following this spike low, and we also saw 503 tons suddenly enter the ETF, so the SLV ETF that very next day. But what it told us was, hang on a minute, these guys have no physical, they have no 1,000-ounce bars, or not enough 1,000-ounce bars, so they're willing to pay over for it. Now, I think what fooled everyone, COMEX-centric, was, hang on, look, retail demand soft. Well, let's short the hell out of silver. It's soft, you know. But what they're failing to see is on the wholesale side, it was not soft. And it takes a while to, as you know, to feed through. And by the time it feeds through and you're seeing $10, $12 premiums in coins, it's already done. You know, it's already done. So to me, it was really interesting that silver, and I really believe that silver at 90 to 1, which is mind-boggling, actually mind-boggling to me to even think. I mean, what kind of a synthetic bullshit trade that is, where you can actually believe in this world that it would take 90 ounces of silver to buy an ounce of gold. I mean, it is pure syntheticness, and as this de-dollarization feeds through, and again, it's going to affect silver big time, and as gold rises, there comes a point where you cannot drive it to 100, 120. What are you going to do? Drive it to 120 to 1 when gold is going to be revalued? What the hell is going to happen to silver? Well, I don't know if you see the same level as me, but most of our liquidity providers figure you get over $35 in silver, goodbye. We're at 50, we're at probably 200. At that point there, you can throw everything out. It's no longer a synthetic market, because anyone that is in trading that ratio trade is going to dump both sides. They want out of that trade. It's no longer a feasible trade. And that means that's where the bubble is. To me, that's where this synthetic world of 90 to 1 lives. Because other than that, it should be 8 to 1, shouldn't it?
Yeah.
WGC analysts reported that the People's Bank of China took the lead among central banks in gold purchases last year, acquiring 225 tons in 2023. The National Bank of Poland followed as the second largest gold buyer, securing 130 tons and boosting its gold holdings by an impressive 57%. In light of these significant gold acquisitions, how will the ongoing process of de-dollarization impact the necessity for gold revaluation in the global economic landscape? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.